Okay, so you want to buy a shopping mall, behind a big empty building, fill it with stores, and watch the rent checks roll in every month. Hundreds of shoppers walking past your stores every single day, and every one of those stores pays you just for the privilege of standing there. Sounds simple. It is not simple. And the story of how malls actually make money and how they actually die is one of the strangest stories in all of real estate. Before you make a single dollar, you need to survive buying the thing or building it. A large regional mall is not a small purchase. Building one from scratch on empty land with all the parking, the plumbing, the electrical systems, the climate control, and the permits can run into the hundreds of millions of dollars before a single store opens its doors. The land alone can cost tens of millions. Then you pour the concrete, put up the steel, run miles of wiring and ductwork, build out multiple levels of parking, and satisfy a small mountain of local zoning and safety regulations. By the time the ribbon gets cut, you can easily have spent more than the price of a small hospital. Buying an existing mall is usually cheaper up front, but that's where things get interesting, because not all malls are the same mall. There is a huge gap in this industry between what people in the business call Class A malls and everything below them. A Class A mall is the kind with a luxury department store, high sales per square foot, a waiting list of brands wanting to get in, and a location near wealthy suburbs. Those trade for enormous sums, sometimes north of $1 billion for the best ones, because the income they produce is stable and predictable. Then there are the malls 2 or 3 tiers down. Older buildings, weaker anchor stores, lower income neighborhoods nearby. Some of these have sold for a tiny fraction of what it cost to build them. One mall in Akron, Ohio, called Rolling Acres, sold for $2.75 million in the early 2000s, and that was considered a lot less than what the previous owner had paid, which was over $33 million. A mall that once had over 140 stores eventually sold again for well under $2 million, and it kept losing tenants after that. So here is the first thing nobody tells you when they picture owning a mall. You're not really buying a building. You're buying a bet on a neighborhood. And the price tag tells you almost everything about which bet you're making. Most people who own malls today, by the way, don't own them the way you'd own a house. They own them through a structure called a real estate investment trust, or REIT for short. A REIT is a company that owns income-producing property and is legally required to pay out almost all of its profit to shareholders every year, in exchange for not having to pay corporate income tax on that money. This structure is a huge part of why large-scale mall ownership exists in its current form. Ordinary investors can buy shares in a mall-owning REIT on the stock market for the price of a cup of coffee, without ever having to personally deal with a leaking roof or a collapsed anchor tenant. The largest of these companies own dozens, sometimes over 100, shopping centers at once, spreading the risk of any single mall failing across a much bigger portfolio. That's a very different game than the one facing a private buyer who puts everything into one building in one town. Say you've settled on a mall and the purchase price seems reasonable. Before you collect a single rent check, there's a layer of costs that catches almost every new mall owner off guard. First, there are the anchor leases you inherit, and you don't get to renegotiate most of them right away. Anchor stores, the big department stores that sit at the ends of the mall, often signed their leases decades ago, sometimes for shockingly low rent, and those leases can run for many more years before you get a chance to raise the price. You inherit whatever deal the last owner made, good or bad. Second, there's deferred maintenance. Roofs leak, HVAC systems that cool and heat over 1 million square feet of space wear out, parking lots crack, escalators and elevators need constant service. If the previous owner was cutting corners to keep cash flow looking good on paper, you find out about it the first winter you own the place, usually in the form of a very large repair bill. Third, there are what's called co-tenancy clauses buried in almost every mall lease. These are contract terms that say, in effect, if a major anchor store closes, the smaller stores around it are allowed to pay reduced rent, or in some cases walk away from their lease entirely. You don't see this cost on the day you buy the mall. You see it the day your anchor tenant leaves, and suddenly a dozen other tenants are legally allowed to pay you less, or nothing at all. That's the trapdoor under the floor. The mall looks fully rented on the day you sign the papers. But the moment one big piece falls out, the whole financial structure underneath it can shift without you doing anything at all. Here's where it gets interesting, because the way a mall makes money is more layered than most people realize. The first and simplest layer is base rent. Every store pays a fixed monthly amount for its space, usually priced per square foot per year. A small specialty store might pay somewhere around $40 to $60 per square foot per year in a strong mall. A department store anchor, by contrast, often pays a tiny fraction of that. In fact, according to real estate analysts who studied Sears store leases before the company's bankruptcy, Sears was often paying somewhere around $5 per square foot in rent, while the average rent at top quality malls was closer to $50 or $60 per square foot for other tenants. Ride that again. The store with the biggest sign and the most floor space was paying roughly 1/10 what the little clothing shop next door was paying per square foot. Why would a mall owner accept that? Because the anchor isn't really paying for space. It's paying for its name. The anchor brings in customers. Those customers walk past dozens of smaller stores on their way in and out. The mall owner isn't renting square footage to the anchor. The mall owner is renting foot traffic from the anchor and paying for it with a rent discount. Every other store in the building is, in a sense, subsidizing that discount because they're the ones paying full price to be near it. The second layer of income is called percentage rent. This is money on top of the base rent, tied directly to how much a store actually sells. A typical structure works like this. A store agrees to pay its base rent, but if its yearly sales cross a certain amount, called the breakpoint, the mall takes a small percentage of everything sold above that line. So if a store's breakpoint is set at $1.5 million a year, and the store sells $2 million that year, the mall might take somewhere around 6 or 7% of that extra $500,000. That's real money that scales automatically with how well the mall itself is performing, without the mall owner lifting a finger. The third layer is called Common Area Maintenance, or CAM for short. This is separate from rent. It's the tenants paying their share of the cost of running the building itself, cleaning the floors, lighting the hallways, maintaining the parking lot, running security, keeping the escalators moving. Each tenant pays a portion based on how much space they occupy compared to the whole mall. If a mall's shared costs for the year come to $250,000 and a tenant occupies 10% of the mall's total leasable space, that tenant owes $25,000 of that bill for the year. This is important because it means a big chunk of what it costs to physically run the building isn't paid by the mall owner directly, it's billed straight back to the tenants. Then there's a fourth category that most people never think about at all. Everything that isn't a store. Parking fees in dense urban malls. Advertising space on digital screens and directory boards. Kiosks in the middle of the walkway, which often charge extremely high rent per square foot because they take up almost no space and sit exactly where foot traffic is heaviest. Pop-up events, holiday markets, seasonal photo booths. None of these show up in most people's mental picture of owning a mall. But for some properties, they add up to a meaningful slice of total income. There's a counterintuitive detail hiding inside that kiosk math worth pointing out. A kiosk in the middle of a busy walkway might occupy less than 100 square feet of floor space, and yet, because it sits directly in the path of every single shopper passing through, it can be priced at a far higher rate per square foot than a full-size store along the wall. Size and rent, in other words, are not the same thing in this business. Position is worth more than space. A tiny cart selling sunglasses in the busiest intersection of the mall can, per square foot, be one of the most valuable pieces of real estate in the entire building. So far, the mall sounds like a machine that prints money from 4 different directions at once. Now here's the other side of the ledger. Utilities on a building of this size are enormous. Keeping over 1 million square feet climate-controlled, year-round, lit and running is one of the largest recurring expenses a mall owner faces. Add to that security staffing, ongoing cleaning contracts, landscaping, snow removal in colder regions, and constant small repairs. A broken sprinkler here, a cracked tile there, and the monthly operating bill for a large mall can run into the hundreds of thousands of dollars before a single dollar goes toward paying down the loan used to buy the place. Then there's property tax, which on a large commercial property in a major metro area can be one of the single largest line items of the year. And insurance, which has been climbing sharply across the entire commercial real estate industry in recent years, especially for older buildings. There's also a detail buried inside the CAM structure that catches new owners off guard. Those shared costs don't shrink just because some of the mall sits empty. The hallways still need to be cleaned whether every store beside them is occupied or not. The lights above a vacant storefront still need power. Security still has to patrol the entire building, not just the leased sections. So when vacancy rises, the same fixed pool of shared expenses gets divided among fewer paying tenants, which means each remaining tenant's CAM bill goes up, even though nothing about the building's actual upkeep has changed. Rising vacancy doesn't just mean lost rent from the empty stores. It quietly raises the cost of staying in business for every store that's still open, which is exactly the kind of pressure that pushes marginal tenants to leave too. And here's the trap almost nobody sees coming until they own the place. Even a mostly full mall can lose money if the mix is wrong. This is the counterintuitive part. It's not just about how many stores are open, it's about who's paying real rent and who isn't. A mall might look at 90% occupied and feel healthy from the outside. But if half of that occupied space is anchor stores paying next to nothing, and a growing share of the inline stores are on short-term leases at discounted rates just to keep the lights on, the actual cash flow can be far weaker than the occupancy number suggests. Occupancy is not the same thing as income. That distinction is where a lot of mall owners get into serious trouble. Before we get to how malls die, it's worth